Hello everyone, welcome back. This is module 3 of Principles of Insurance and Risk Management. In this lecture we are going to discuss one of the risk financing methods, that is retention. Now let's start with this lecture with what does it mean by retention. Retention means the firm or the organization retains part or all of the losses either actively or passively. Active retention means the firm knows is a loss exposure and it is intentionally keeping those losses. For example, a firm may retain all the loss exposures due to physical damage, and passive retention means the firm doesn't really know about its loss exposure. For example, a firm may not know how much it could lose due to an earthquake. Retention is effectively used if there is no other method or treatment to avoid losses. Secondly, if the worst possible loss is not really serious. And finally, if losses are highly predictable. In case of retention, firms may like to measure the retention level, which means the amount of money, the amount of losses that the firm will retain. There are several methods for retaining losses. First of all, firm can pay losses from its current income, and these losses will be treated as current expenses. Then losses can be deducted from unfunded reserves, that means from the bookkeeping account. Firm can also deduct losses from funded reserves, that means from a liquid firm. And finally, firm can also use the credit line, that means firm can borrow money to pay losses when they will occur. There are some advantages and disadvantages of retention method. So these advantages include firm can save on loss cost, firm can save on loss on expenses. So it can also encourage loss prevention when the firm will retain the losses. So firm will definitely take some measures to prevent the losses. In the meantime, as it saves on loss cost as it saves on expenses, it will increase firm's cash flows. And there are some disadvantages of retention as well. It is also possible that there will be higher losses, higher expenses and higher taxes due to loss retention. That's all about this lecture. In our next lecture we'll learn another risk financing methods, the second one, which is non-insurance transfers.